Okay, so here we are. Another good day. Look, yesterday we spoke about the stock market. It was a good day. It carried over mostly to today. But there are still surprises. We still have some issues to get through. I'm going to share with you today what the real problem is, why stocks just can't catch a bid and steady. And even though we had a decent day today, there's still work to be done. And it's all about guidance. So we're going to talk about that. You're watching Be the Boss of Your Money. This is my live stream. It's about personal finance, investing, helping you avoid mistakes, helping you do things right. That's the goal here, right? While you're watching, if you have any questions, hit me up in the comments. If you want to send me a DM because you have something that you just want to ask me that you don't want in the comments, hit me up there. You're welcome to call me. My number 631-920-6622. It's not a call-in show. It's just giving you my work number. You can call me there if you want to speak with me, set up a time, go right ahead. You're watching Be the Boss of Your Money. It's my live stream show. I do this every Monday through Thursday at 4:30. While you're watching, give us a like, a heart, an applause, celebrate, whatever the reaction is available to you, depending on which platform you're watching on. We stream to Twitter, to Facebook, to LinkedIn, to YouTube, and I post a lot of stuff, a lot of content on Instagram. So at InstaMitchG, I'll put up the social media handles right here. Check those out. I'll put those on and off throughout the show. I think right now the key is to roll the intro. I want to give you a quick update on Nvidia. It's just Nvidia today is going to be tomorrow's headache. That's what I'm thinking right now. And we'll check it out. But not all is lost. We have things to be positive about as well. Okay, it's not just all tech. Here we go. All right. Sometimes I have to actually look at my phone to make sure I know when the intro is over, and it looks like we're good. All right. So check me out at InstaMitchG on Instagram, Client First Strategy on YouTube, Mitchell Goldberg, AAF, AAMS on LinkedIn, Client First Strategy on Facebook, at InstaMitch. If we're friends, you know me personally, you want to connect with me on my personal Facebook page, Mitchell Goldberg, go right ahead. I'm pretty easygoing with when I get friendship requests, as long as I don't get like hitting the DM with some kind of sales pitch or something. All right, and as long as you don't get like a little batty with your posts. Okay, so let's get into it today. Today was overall a decent day in the market. Federal Reserve, Fed Chairman Powell, his minutes from the last meeting came out today, and basically they said the Federal Reserve is going to continuously jack up interest rates, 50 basis point moves for the next couple of months. I don't think this is a surprise. I don't think the Fed was more hawkish than what was already factored into the market. And also, I think that so that's one reason why stocks were able to go up today. Another reason is because the Fed is now becoming known as an inflation fighter. Listen, since the Great Recession, the Fed, okay, when I say the Fed, the Federal Reserve, okay, the central bank of the United States, the Fed, the Federal Reserve, has been trying to get interest rates and inflation higher for a long time. Inflation has been very low. And there have been many times in the last 11, 12 years that the Fed was worried that inflation was too low and it would cause problems for the economy. So the Fed kept interest rates very low, not just since the pandemic, but for the decade before the pandemic. Since about '08, the Fed has kept interest rates very low. Every time the Fed has tried to raise rates, it would turn around and slash rates again because it always became a problem and the economy was more sensitive to slightly higher interest rates than the Federal Reserve, than the Fed expected. Okay. It's been a long day, guys. Okay, I start the day early. I want you to know, but for you, it's right now. The show starts at 4:30, but I've been doing this for it's been like a 10-hour day already. So anyway, well, maybe 11. Yeah. So going on, continuing, the Fed's been trying to engineer inflation by keeping rates low, quantitative easing, printing money, and it finally got what it wants. I don't think all of the inflation today is to blame the Fed. A lot of it is though. Enough of it is that it's a legitimate blame game here. Legitimate to blame the Fed. They overdid it. They printed too many dollars, kept interest rates too low, and the Fed is probably should have cooled things, a year ago. We could debate 6 months ago, a year ago. They should have cooled things. Plus, Congress has spent a lot of money on all kinds of programs, trillion-dollar programs into the economy. So we have the inflation now. The Fed is pulling back. So this is the biggest thing that investors face. If the Fed is pulling back on, just trying to get the microphone in the exact spot I want it. Okay, it's good enough. If the Fed is trying, if the Fed is done lowering interest rates and it's done printing money, it changes so many things. It changes. Hey Jerry, I see Jerry. I see you out there. It changes so many things. So it changes the ability of the stock market to print more stocks. If companies to go hit the public markets with more stocks, it changes the amount of money going around. Companies and borrowers and lenders all of a sudden don't want to be as aggressive in borrowing or lending. So it lowers the velocity of money, the money supply as well. The velocity of money just means how quickly money changes hands. Okay, that's the velocity of money, and it's such a huge sea change in what we've seen over the last 10, 12 years. Now, you could say interest rates have been going down for 40 years. There have been plenty of times when interest rates have gone up. Certainly since I've been in the business for 32 years, and I've seen the 10-year Treasury at almost 10% in my career. So people see it go to 3%, and they're freaking out. I'm like, I remember when it was almost 10%. I remember my first mortgage was like 1995. My wife and I bought our first house, and our mortgage was 8%. And we thought we were like so smart because we got the best rate of any of our friends. But a month later, mortgage rates were 7.5%, and they were just sliding and sliding, and they've bounced around between, let's say, 6.5 and 2.5 over the last 25 years, right? But things are going up now. Mortgage rates are in the 5% range. It just changes the whole equation of how much things cost. If houses are staying at the same price or going higher, the cost of a house, but mortgage rates are up, it just becomes so expensive for a buyer to buy that house. And I think that's one of the reasons why you're seeing home sales coming in so light. That just home sales have been plunging the last couple of months. Plunging. I'm not being, hyperbolic when I say the word plunging. All right. So it's really coming down. Now there is a LinkedIn user over here. I don't see your name. It just says LinkedIn user, but I appreciate the comment. I remember 16% car loan in the 1980s. Yeah, look, I grew up in the 80s. I went to high school and college all in the 80s. Um, and it was a great time to grow up and a great time to just to be in the world. Just such a lovely time. I mean, our biggest fear was that we would go to war with Russia and we would have a nuclear holocaust or something. But we weren't really worried about the kind of fears that we worry about today, like sending our kids to school and seeing the school get all shot up. And we saw it happen yesterday in Texas. My God, I'm shocked. We're all shocked. It's just, I think I've been thinking about it all day. But yeah, so interest rates go higher, it changes everything. The other thing is it's hard to get materials to build things. So it's a constant battle. Companies are constantly saying we can't get enough goods. It's not just they can't get enough goods. There are actually a lot of retailers now whose inventories are becoming bloated. So what is the deal? Are we not making enough products for consumers to buy, or are inventories building because consumers are buying less because they're paying more for gas? It's a little bit of both. Both of those scenarios are happening at the same time. But the real knock against the stock market is guidance. This has been a really big earnings season, which we're pretty much at the end of, where so many companies are either withdrawing guidance or lowering their future guidance, and it makes sense. Like, how could you give guidance when you don't know if you're going to be able to get all the materials you need to build the products that you manufacture and sell? How do you know what things are going to cost next month? How do you know if your labor pool is going to be steady, if people are going to be leaving, quitting? The great resignation still goes on. It's so hard to make any kind of forecasting. So companies, to be conservative, are going to lower their forecasts to be on the conservative side. So if their earnings do hit lower than expected, it's okay. The companies will say, well, we guided you lower. If they beat earnings, well, it's good. Then it's an upside surprise, and they did better than people thought. But that's why it's so hard to be an investor right now. Now, for me, for you, we're long-term investors. You could buy a quality investment and hold on to it. But the institutional investors, the big money, even if they're not the big money, they are the big money. Even if they're not the smartest money, they're the big money, and the big money moves the market. We all know that is, if they decide they don't want to own stocks, if they decide they want to take their ball and go home, it affects the market. It pulls liquidity out of the market, meaning that when investors buy and sell, it has a greater degree of impact on the current price of a stock, the minute to minute price of a stock, the second to second price of a stock even. So liquidity is coming out because we just don't know what a company's going to earn. We're blind without a cane in terms of how do you value companies if you don't know what they're going to make, what they're going to do. And that to me is the single biggest reason why the stock market has been so weak this year. We had a good day today. Let's take it to the board. Okay. Let me just get rid of the social media icons are kind of hanging out there. Okay, that's better. All right. Let's make this bigger. Look, I don't, believe it or not, guys, I start the show like literally at 4:30. I just throw my screens up and that's it. It's not every day that I can really prepare for the show. And a day like today, I just go live and I talk to you like a friend. Like this, here's what's going on, and we don't have to get overly fancy and formal. Okay. But the Dow is up 192 points, Nasdaq up 170, S&P up 37. Not a bad day. Gold off a little bit, oil up a drop. 10-year yields are continuing to come down on bonds, and the VIX dropped below. It's still below 30, but it's down further below 30. Twitter jumps after Musk increases commitment and takeover bid to $33.5 billion in talks for other funding. Who knows what's going on with that? I'll tell you what. If you take a look at Twitter, the deal was supposed to be $54, 54 a share, and then it seems like Musk got cold feet. So it's up. The news is making a big deal. Oh, the news is making a big deal. Twitter is surging. Big deal. It's up $2.84. The deal that Musk proposed was 54, and the stock traded to 51. Some people ask me, well, should I buy Twitter if Musk likes it? I'm like, no, don't buy it because of him. Listen, Musk also touted Dogecoin, and it went from like 15 cents to 75 cents. Now it's at like 8 or 9 cents. So I've always said this. I don't like when people who are in a position of influence or authority in the stock market tout certain investments because you don't know who is listening to that, how unsophisticated an investor could be, and they're gambling their hard-earned money on the stuff like Dogecoin. And Twitter looks like another one. Now it's under 40. So who the hell knows? Let's take a look at the bond market. Yields on the long term, like the 10-year Treasury, long-term bond market, long-term bonds have come down even a little bit more. That's a continuation of yesterday. Crypto is up a drop after being down. So, Bitcoin 29,715. Not the worst thing. We will take it, but it's a mixed day for crypto. Not a bad day, just a little bit of a mixed day. Here's Dogecoin at 8 cents after Musk touted it, and I can't stand when people do that. Yesterday we spoke about a couple of stocks like Zoom, which was up $5 yesterday or so, and now it's up 8 today. AT&T up 14 cents. I didn't talk about AT&T yesterday, but I spoke about Zoom, saying that Zoom is like the single best example of a poster child of the pandemic stocks, the Great Recession stocks that worked out so well from 2020 to 2021. But Zoom is up again today. I know it's off $1.69 in aftermarket, but it was up 8 today. Okay. AT&T was like $19, $18, $17, $18, wouldn't do anything. And I've been talking to clients about this because we have some and down in it, but that's besides the point. I feel like Twitter, I feel like AT&T has become this sleeper stock that is starting to move up ever so slowly, and no one's really paying attention to it. And by the time people notice it, it could be a good deal higher. That's just how that's not my prediction. That's how I see it. That's my observation. I think it's a sleeper stock. It's been washed out for years and years and years. They finally spun off the media assets, and now they could become the true blue, 5G play that investors really wanted. JP Morgan was up 88 cents today, down over $1 in aftermarket trading, but at least it's bouncing off its low. Costco is just like 400. It's up 89 cents today, but it was up $2.40. Well, it's up 89 cents in aftermarket, but it was up $2.40 in the regular session. Okay. So that is a couple of stocks to keep track of. Let's take a look at Nvidia. Okay. Nvidia stock falls over 10% unlike guidance. This hurts because Nvidia is down a lot already, and it's supposed to be such a juggernaut of growth. And then earnings come out, stock drops a lot, down $11 a share. This does not bode well for tomorrow. It was up $8 today, but it was still down even more than that in aftermarket trading. But we'll see. By the time the conference call comes out and we get into tomorrow morning, this could turn around and investors could become very bullish on it. So that's how quickly things move. So I'm not going to really read into this, but obviously if it stays like this tomorrow morning before the market opens, you could expect a down day in the Nasdaq is my sense. All right. Let's go on. Nvidia. Okay. Nvidia runs just something else, but I'm not going to say it. Okay. Cheapest stocks in the market on the Nasdaq. Okay. These stocks are down 50% from their average forward PE ratio. Not all of them are down 50, but some of them are. But Meta is one of them. Here it is, down 39% discount to its normal PE ratio. Now, would you buy these stocks because they're at discounts to their average forward PE ratio? You see, I take a look at them and I see AMD, computers, Skyworks, phones, Qualcomm phones. There's a slowdown in phones and computers right now globally. People bought the stuff when they're home for the pandemic. They pulled forward demand. They bought stuff. They bought things. Now people are looking for services, experiences, that sort of thing. So you don't get these stocks on the cheap because they're bargains and nobody else knows it, just you, and you're going to buy them and swish, the stock goes right back up, and you're just all of a sudden going to make a lot of money on them. These stocks are down for a reason, cheap for a reason. Are they values or are they value traps? And a lot depends on the state of technology, the state of interest rates, the state of continued 5G adoption. So, like, I adopt 5G, I adopt strategies, I adopt pets, and I also adopt children, if you didn't know that about me. But we have to see where these things go. Anyway, that's my show. It's kind of a short day today. It was a decent day in the market. It's all up to Nvidia now for tomorrow. Nvidia is a crucial company in the supply chain of the future of the internet, of artificial intelligence and other things. So if if Nvidia is not doing well right now, or not doing as well as expected, it does. I think it should be expected that it'll weigh heavily on the rest of the market. Um, Twitter. That's really about it. I got nothing else. All right. I appreciate you guys watching. I will see you tomorrow. And again, if you think of any questions that you'd like to ask me, please hit me up in the comments. I will definitely see those. Thanks and have a good night.